Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark looks at the rising U.S. dollar. Institutional Advisors market historian Bob Hoye on Crude's continuing rally. Danielle Park from Venable Park Investment Council explains how you can make money outside the stock markets. We'll talk to Ross Clark right after this.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. Welcome back to This Week in Money, Ross.
I always look forward to it, Jim.
The Canuck buck, well, it did not too bad, I guess, with the price of crude coming up, but the U.S. dollar is still the big talk in the currency markets.
Yeah, the U.S. dollar strength there, it all started a couple of weeks ago. The dollar broke down just through supports of the last year or so, just enough to take out the last of the week longs and reversed on a dime, and it's done very, very well on the upside. We're now through the best levels in the last month and a half, closing up about 95.60 on the dollar index. And one thing I've been looking at is the commitment of traders numbers, which show us the breakdown, which gives us the commercial positions and the speculative positions for large traders, small traders, etc. And most of the time, the figures really don't jump out to you. There's nothing really significant. You want to see either extreme levels on a historical basis, or you want to see rates of change that have been moving quickly. Because rather than absolute levels being that important, it's that rush of investors or the funds to get into positions or to either on the long side or the short side. And invariably see that as you're getting to the climactic stages of moves. And in the last month and a half, we've seen quite a bit of that. The Canadian dollar rally, I think it was 15 or 16 weeks to the upside. At the tail end of that, we saw large commitments committed to the long side by the speculators, and the short positions increased dramatically by the commercials. In the gold market, we had 10 weeks of extremely high positions by the speculators, and now the price has been rolling over. We're 4 weeks on the downside in gold, down a good almost $100 off the highs, and starting to gain some momentum here. Silver, the same type of thing, high COT numbers for 2 of the last 4 weeks, and it's starting to show some vulnerability. And on the oil market, crude oil has just in this last week moved up to the $50 level, and the COT numbers there are punching through the bands that we look at, the Bollinger Bands, and that has been the type of occurrence that you see within a week to 2 weeks of interim highs. And going back over the last couple of decades, there's only 9 or 10 occurrences like the one we have right now. So I think this $50 level that we're pushing up in crude, if it can have a few days with extra oomph to the upside, maybe getting the relative strength index up into the high 70s, and it's around 70-ish right now, but if there was that last little push, then it could come on some inventory numbers in the next week or so. That would set us up for some vulnerability, and I think at this point, the correction might be a little deeper than we were originally thinking. You're probably getting back to the 100-day moving average. Probably under the $40 level would be the numbers we'd be taking a look at there.
Now, Raymond James back in January predicted $60 crude by June. Do you think they're going to make their goal?
Well, and June starts next week.
That's right.
And that I think becomes maybe a little bit higher than I would expect to see. The tail end of the move. If we were to tack on $2 or $3, that would be enough for me to say that we're into overbought territory and ready to see some vulnerability. There's no question that as we do get into these higher numbers, that we're going to start to see product come to the market again. So there's going to be a lid. Where it actually comes into play is anybody's guess. But I think the key will be, just like it was with the Canadian dollar, you pick levels at which you find that it's overextended, and then you watch for the momentum to change to the downside. So rather than say it's 50 or 56 or 60 or some other number for the absolute, let's see what happens. Do we lose momentum? And if we do, then we start to talk about numbers on the downside. So for now, everyone's got a number, and Raymond James has theirs.
Gold and silver, how have they done?
Well, with this strength that we've seen in the dollar index, we've got just the opposite happening in gold. The gold closed off the week at $12.10, and when we made that move into new highs, we had closing highs at the 1273 range, and popped through there up to just through 1300. It was very, very important that this broadening pattern that we had, that we didn't close back inside it by more than 1%, and that we didn't close back below the 20-day moving average. Well, both of those happened about 10 days ago, as we got into the 1260 for the support level, and it was 1265 for the moving average. Getting to that put us into this vulnerable stage, saying that the uptrend was no longer being supported, and we were going to need to clean out. Because we had these all-time high levels for speculative positions, the probability here is that we're going to have a number of weeks still on the downside before this market has cleaned itself out. And when I look at the other styles of lows that we've had, the retracement here, I think you're looking at somewhere in the 1155 to 1160 range. Probably see that during June. I wouldn't be surprised that it's in the first half of June. And from there, you get your first decent bounce. Have to be careful here. We've got this upside reversal looking like it's happening in the dollar index. If it continues to push through 95.70, that's where the 12-month moving average is, I think it can push towards par. And a move towards par on the dollar is going to put reciprocal action on the downside as far as the gold's concerned. So, say 1155 to 1160, maybe the initial support. If we get a bounce from there and the dollar's continuing to have upside momentum, the U.S. dollar, then probably look for much further to the downside on gold.
Ross, thank you very much for chatting with us.
Always a pleasure, Jim.
My guest has been Ross Clark, investment advisor at CIBC Wood Gundy, Vancouver. Coming up, market historian Bob Hoye on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. My guest is market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. Welcome back to This Week in Money, Bob.
Yeah, Jim, good to be with you and good to be with our listeners out there.
The stock markets in Canada and the U.S. had a nice rally coming out of that disastrous February-January period. Is that rally going to continue?
Well, many people would like to see it continue. It's the old extrapolation process about what's happening now will continue, but there's been a lot of enthusiasm expressed, almost as equivalent to the dismay at the very weak January for the opening of the year when, the stock market got oversold, sectors within the stock market got oversold, junk bonds were a disaster, base metals were a disaster, crude oil was a disaster, so there was a lot of pressure there, and as we like to do is to keep track of the seasonals, and the key of the last while, of course, was that crude oil could have a very good seasonal low in January. And then when you had an absolute panic going on, it did really basically clear all the problems in January, and we had the technical measures on that. And then, of course, I think back in 2014, about 18% of all new junk bond issues were from the oil patch. So then you had that problem there. So now you've had first of all, the relief rebound out of a very oversold condition. And then more lately, just positive seasonal influences. You can have a good high for crude oil in May, kind of a correction for a bit. And this is what we're looking for now. And this, I guess, is a good one to talk about because it is the main conditioner on the market. So with crude rallying, that really helped the oil patch. You had a terrific rally for the oil stocks. And it's also, Jim, had a really good effect on junk bond prices. They've rallied terrifically. And this then is the credit spreads, which is the difference between high-grade bonds and low-grade bonds, has narrowed in terrifically from about 20% spread down now to in the 15s. So, yeah, it's huge. But again, this is now on the credit spread market with junk bonds a seasonal move. So if you take a look at junk getting killed right into January, then the rebound, which was technical, and then now this leg, which is seasonal. So it's all coming together rather nicely, and so sometime within, I guess, the next 4 or 5 weeks, the seasonals on credit spreads could reverse as you get a correction in crude oil. And you could probably get more than a correction in base metals. Indeed, copper dropped all the way down to 205, almost as low as it was in January. That's just pretty scary. And the other base metals could weaken as well. We did see a terrific lumber price rally up to, I think it was around 330. And now that's beginning to correct. We don't, the lumber seems to march on its own. It got very oversold last October and then started its rally. So it doesn't seem to trade with the other industrial commodities. But we just see the opportunity there as it became very overbought a couple of weeks ago. So the outlook for commodities, where you've got most of the industry in either the brokerage side in analyzing base metal mining stocks, and then certainly the treasury departments at the big mining firms are all hung up on supply-demand analysis. So, of course, you focus too much on that, you'll never get the price changes when they come in. So anyways, this rally in precious and base metals has really got all of the supply-demand guys going. And, of course, for silver, for example, they always show that year after year after year, there's always a deficit in supply and demand. And that on that basis, they figured silver should go to the moon. Well, it rallied to the moon this time and is giving up. So, but anyways, to get back to the orthodox side, you've had a reasonable rally in the retail sector, and it is rolling over quite seriously. You've had a pretty good rally in banks and financials, and that was helped by the rally in crude oil. And they then they'd be eligible now for another decline. And the one thing that's been working against the banks and financial stocks recently is that the yield curve, which is the difference between longer maturities and shorter, was positive from early in the year for bank stocks to about 3 weeks ago, and it's been adverse since. But helping the banks have been the narrowing credit spreads. And so now we're looking at the yield curve is already negative for banks and financials, and the spreads have yet. So they're still supportive, even as to yesterday's posting. So I think there's an opportunity in here to be lightening up on some of these retail and particularly the banks and financials. They've had a terrific rally.
Many people predicted that the financials would be into tough times right now because of possible defaults in the oil patch.
Yeah, that was the pressures down into January, but with the rebound in oil price, those concerns become parked. Everybody started. I mean, most of the whole industry has a tendency to be positive. So in here you've got crude oil come from 27 up to and touching 50 the other day. That's an outstanding rally. And but it's not sustainable for two reasons. It's overbought, and the other thing is you're due for a seasonal correction in here. So that then is going to feed back into the bank stocks. So, but it's amazing just how quickly that changed from gloom in January on most everything to now lots of confidence. And but you had Goldman Sachs when crude was down as low as 27, they were saying it could go to 20, which was just reinforcing the concerns of the day. And I understand more recently that they're now saying higher prices, but that's the way the market works. It takes a lot of discipline to, first of all, put together the techniques whereby you can measure the degree of oversold as it was in January, or the degree of overbought as it is lately, and then act on it. So our advice would be to take some money off the table. It's been a terrific trade, and wait and see what happens next.
You're listening to This Week in Money. I'm Jim Goddard. We're chatting with market historian Bob Hoye. Bob, what's the outlook for the Canadian dollar? It touched 80 cents. That looked pretty good, but then it dropped quite quickly.
Yeah, it's unfortunately has become known as a commodity currency, and like Australia, and we are resource-based, and it's understandable that this happens, but it need not happen. The wisest thing that could be done on the Canadian dollar would have been, when it was trading at par with the U.S., to just put in what they call a currency board, whose job is to keep it in line, pegged to the U.S., because, we've got, 4,000-mile border, lots of trade north and south, and the trade Canada too there is, of course, huge for us, and it just makes the whole system work a lot better. Whereas that now you've got small merchants, everybody else is trying to hedge themselves against currency change, and you've got then the problem of the Bank of Canada, our central bank, who has been dominated by Keynesian thought, who got these ideas that if you depreciate currency, you get a certain amount of growth. Well, this is the last 4 years of showing that theory really doesn't work. But nonetheless, until you get rid of it, you have to deal with it. And but they'll rationalize and say, the weaker dollar, to Vancouver or the Okanagan Valley, this brings in tourists. So we should suffer a weak dollar so that foreigners can enjoy themselves on our expense. I don't go along with that. But at any rate, until these intellectuals in central banking are constrained or moved out of their positions of power, we'll have to face it, and the Canadian dollar is going to head on down. Now, the other thing affecting the Canadian dollar will be just plain bad government. These you had the Conservatives in office for approximately a decade, and essentially they tried to reintroduce the concept of limited government. Well, the establishment got upset about that and called it austerity, as if government is a cornucopia of bounty. I mean, that's another absurd one. But at any rate, it upset the establishment. They've thrown out these monsters who insisted on the concept of limited government, and we now have a federal government that will be just as ambitious as the province of Ontario government has been, which has turned Ontario from the have province to a have not province. But somehow you just seem to have to go through it. When we've seen socialist governments come and go in British Columbia, and one of the conclusions you can make, it's like having a house cat. When they go into the living room, you know that they're going to claw the furniture. And so you stand there at the living room, slap your hands, and they then look guilty and scurry away. But here we are now. You've got the socialists in Ontario, and you've got the socialists federally now, and they are going to claw the furniture. And there's nothing we can do it until they do enough damage that you have a popular uprising and the folks throw them out of office. But that will be 4 years from now federally, and not soon enough in Ontario.
At the G7 meeting in Japan, you have, of course, people representing about half the world's economy, and coming out of that meeting, none of them could agree on what policy is best. Is austerity the way to go like it has been in Germany, or do you spend your way out of trouble like Canada? The only thing that they agreed on is that Donald Trump scares the hell out of them.
Yeah. Well, Trump, I think, is representing, well, it's not so much that he's leading the movement in the United States. It's that the movement, a popular uprising, chose him as a leader. And he sure is dynamic. He is rough in statements, and you're not quite certain what his policies will eventually be, but they won't be too far away from what this popular uprising will be demanding, and it will be limited government. Like, you can say that for decades now, the political movement, the power has been in your face and in your wallet government. So they impose themselves in your life and then expect you to pay for it. I mean, this is not a good political contract. It's a one-way one, and you have to beguile the taxpayers in order to extract the money from them. There was a French Minister of Finance back in the 1600s who said that taxation is like plucking a goose. You want to get as many feathers as you can without the goose squawking. Well, the trouble is that those who are ambitious to expand government have no discipline whatsoever, and they will push hard enough that they're going to upset the public. And certainly Canadians can enjoy a popular uprising every bit as much as Americans can. And this one should be compared to the popular uprising in Eastern Europe in the late 1980s, when the folks looked then at the promises the governing classes were making. They looked at how well the governing classes were living. They looked at how they were living and suffering. They said, enough, we're out of here. And they took on a police state that was not hesitant to use tanks and AK-47s to impose their will. And the public, the uprising, took down the Berlin Wall, which was the symbol of the period. And I think there's no reason why in North America one couldn't see a similar type of uprising.
Trump.
Here I am preaching revolution.
Bob, one positive thing perhaps for Canada is that Trump says he would approve the Keystone XL pipeline.
Yeah, he has not succumbed to the notion of man-caused global warming. That really is pseudoscience, absolutely backed by nothing. And fortunately, he sees through that, and prosperity ultimately depends upon people free enough to make the right economic decisions rather than having a bunch of bureaucrats impose their ideas on you. And perhaps if the Americans can sort out and limit the passions of anti-pipeliners down there, we could then perhaps look to getting the pipeline sorted out in eastern Canada, where Canadian oil could flow to Canadian consumers in the Atlantic provinces and in Quebec. I mean, what's wrong with that? So anyways, besides that, what is there? Pipelines, petroleum, either natural gas or oil pipelines in the United States, I think there's 2,500 miles of them already, and the Keystone is a minor percentage increase in the amount of pipeline, but it sure is an issue. But yeah, if Trump wins and becomes the next president, and he has said that, you can rest on it that pipeline will go ahead, because the main reason why it has not gone ahead is purely Obama, because eventually the environmental issues were satisfied and the Department of State eventually blessed it, but it was just all in the extreme hard left in the United States as fronted by Obama. So we live in very exciting times.
Bob, thank you very much for being on This Week in Money.
Good to be with you, Jim.
My guest has been market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. Coming up next, Danielle Park on This Week in Money.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. Welcome back to This Week in Money, Danielle.
Hey, thanks, Jim.
Could you tell us a little bit about Venable Park Investment Counsel?
Oh, Venable Park is a independent risk management firm. We operate out of Ontario, but we have clients across North America. Sort of like a family office style. We don't sell any financial products of any kind. We manage assets for a fee for clients with account size of $1 million or higher. And it's not prescribed to any particular asset class. We're not mandated to be long always in equities or bonds or anything of that nature. We are basically always looking for the best, lowest risk yield that we can find for clients. Absolute return, meaning instead of benchmarking ourselves and, losing less than the market and considering that success, our motive is always to avoid losses and to outperform GICs net of fees with a fraction of the volatility of buy and hold. So it's really quite a different approach than the average fund manager or investment advisor out there who typically work for product selling institutions and make the bulk of their fees by getting people into various risk assets. We always thought that was a conflict of interest. So when we started Venable Park many years ago, we decided that we wanted to have no bias whatsoever and that we could just, do analysis of risk and reward probabilities and put savings in the safest places that are going to generate above average returns over full market cycles.
Danielle, I should say that a lot of your recommendations or the stories that you talk about are not what you see in the regular investment trade journals or blogs and so on. They're quite unique, and it's something that I appreciate because you have, I would say, kind of an alternative point of view on investment.
Well, you'd need to, Jim, because quite honestly, the industry is 98% biased towards keeping people in risk assets 24 hours a day, 365 days of the year, no matter what the risk-reward profile looks like, because the bulk of the industry's fees come from the, quote, highest risk stuff, like the equity side, the structured products, the wrap accounts, all this stuff. And we figured out, we worked on the sell side, my partner and I, Corey, in the mid-1990s. And when we were watching what was going on with the end of that secular bull, which in our humble analysis we thought, 1982 to 99 was probably a secular bull that was ending, and then you were going to be facing an equal and opposite period, perhaps 17 to 20 years of sideways to down markets where any kind of buy and hold was going to be, look like you're getting ahead for a while and then be capital devastation and to set you back by 10 to 12 years each down cycle. So we really wanted to start a method that would row through all market conditions and not subject people to, this kind of return-free risk, which was what the buy and hold approach we thought was going to bring. And in fact, that's been the case. And we're now year 16 into a secular bear that began in 2000. And so far so good. The turtle wins the race. The slow and steady gains, it turns out, are much better suited to real-life people who build savings slowly over time and then often in lump sums that come to them when they sell a business or a property or they gain inheritance. Traditional models, if you walked in with a large sum of money tomorrow, they would have it in risk-based assets the week after. Whether or not we were late in an expansion cycle, whether or not equities had already appreciated a great deal, or whether they had fallen a great deal, would be not even considered in the equation. It would just be get the money in the market because that's where the firm starts collecting the fees. So we again said that's not in the client's best interest. We need to be a fiduciary. We need to do what's right for the client at all times.
That is an amazing business model, isn't it? Look after your customers.
Well, it turns out it's unique. I didn't realize at the time that it was quite as unique. Perhaps because I was a lawyer in my previous career, and so working for clients and having a fiduciary duty and having to put their interests first and not collecting secret profits, these were all just sort of part of my DNA, so that made perfect sense. And when I transitioned to the finance business, I thought, well, geez, you have to still you surely have to continue with these precepts, and so that's where we founded Venable Park based on those ideas.
Looking at your blog, Juggling Dynamite, one of the items that I noticed was seniors plan to keep working, what I call the Freedom 95 plan. Are they going to work to look after day-to-day expenses and perhaps save their pension?
Well, that was CBC did a nice, Anna Maria Tremonti in The Current did an interview with some people in their 60s who are really reflective of the majority in most of the Western world, frankly, certainly in Canada and the United States, that, they're people who were baby boomers who came into their savings years during the 1982 to 99 secular bull run and really grew up with the financial business, who was selling the risk and making outsized gains for a period of time. And then they really sort of got brainwashed into the idea that you didn't need to save much because the market would make up for all deficits. And so it was a time of increasing risk appetite. And unfortunately, because of the way these secular cycles move, as I said, 17 to 20 years up and then followed by an equal and opposite period of down, typically in the other direction, that's really hit the baby boomers at the worst possible time. It was a great lift and benefit to them early on to be making outsized gains, but frankly in the early 80s and early 90s, the boomers didn't have a lot of capital at risk. They hadn't yet accumulated much savings, as I said, hadn't sold a lot of their businesses and, inherited from their parents and all that. But in the last 10 years in particular, as they've moved towards their 60s, they're getting to that point in their life where they had always thought they would not be working. They had always assumed they would have a house paid for. They had always assumed they would have pensions. They would have enough savings. Well, it turns out the autopilot approach did not work, and no one was really paying attention to the risk, and no one was really paying attention to price. And the theories have really come to haunt the reality of many people, and they're just underprepared. So I like to talk about, it's not that life is impossible or you can't go forward from here and have, happiness, etc., but it's just that you have to really realize that many of the things that you came to believe were true were false, were misleading, and have been harmful. And you really have to wake up and want to see truth in order to recalibrate the approach. So for a lot of people, as I said, this whole idea of Freedom 55 always was farcical, because I'll tell you why, because no one was actually funding the plans or saving enough to account for the fact that they wanted to then stop work in their early 50s, take a big income, and typically an indexed income was the expectation for the next 30 years or so, Jim, because the average person, if they hit 55, tend to be going into their 80s. And that's a totally different dynamic than in the good old days when, people would work till 65 and be dead by 70. We're in a world where people are living, as I say, routinely to 80, and yet they haven't saved for that. They haven't paid down their debt quickly, and lowered their consumption in their present in order to amass savings for future consumption. Those concepts were really thrown out in the great credit bubble and the big asset bubble, stock bubble. We've had 3 now since 2000. So as this one comes off, as valuations are right back at extreme highs in corporate bonds and stocks, and people have still not made up deficits that accumulated in the last 2 massive bear markets and still didn't increase their savings sufficiently. As an example, the savings rate in the United States in 2015 was only back to about 2.5%, and in Canada is roughly that. And the 50-year average before that was above 6%. So again, we became this nations of non-savers or meager savers, but we had all this expectation for the extraction phase thereafter. So unfortunately, it's a rude wake-up call. The later people understand the math, the more difficult it is, because now, they're facing working into their 70s in many cases. But I like to get this information to people early, because if they can get truth early and moderate their behavior, as I say, you don't need to be a helpless victim. You don't need to just toss your financial fates to the winds of the crap tables and speculation that's going on in, various risk markets around the world. You can actually be much more empowered than that. And you have to just understand how math works, how the math of loss works, why savings have to compound. The magic of compounding, that means savings actually have to be growing gently, but growing year over year over year. When you're in these big whipsaws of bull and bear, because valuations get so extreme and people are on the short-term trading mentality and all that, what ends up happening is you make some gains and then they are all taken back and then more, so that you're back to where capital was sort of 10 years before. And as I say, once you get to your 50s, even into your 40s, you really just don't have enough time to keep making up for these massive losses that take years to recover.
Danielle, the country of China is now recommending that its citizens eat a plant-based diet. Is that good news for people who are really worried about the high price of steak in Canada?
Well, I don't know about that, but it's very good news for many fronts. It's very good news for health. It's very good news for the planet. It's very good news for the climate. Because the reality is that with all the hullabaloo about fossil fuels and, transportation pollution and all that, which is all legitimate concerns, the fact of the matter is the bulk of the world's greenhouse gases emissions are coming from this this animal agriculture business. Depending on the study, I've read many of them, depending on which parts of it are included under the animal agriculture, but basically 15 to 51% of all the all the greenhouse gas emissions that are culminating in the world are coming from that industry. So it's funny, I'm very excited about electric cars and all that, but I figured out some time ago it makes no sense to say that you're concerned about the environment and yet continue to have a heavily meat-based or dairy-based diet. So not only that, but on a health basis for individuals, we know that there's a lot of dis-ease and inflictions that arise from an animal, a concentration of animal input. So in China, the irony is, of course, coming from less prosperous background, they had a very plant-based, rice-based diet. But as things have gone on, and certainly in the credit boom since 2000, the inflows into the country, the increase in the standard of living, the aspiration was to acquire a Western-based diet. And of course now, not surprisingly, Jim, they're also seeing a spike in things like obesity and heart disease and all the things that naturally flow with that kind of diet. So I thought it was quite interesting that, that the Chinese government, the Ministry of Health, is trying to kind of ward that off at the pass and say, hey, we've learned from watching other Western countries that this is actually not a healthy thing for the body, and that we don't have to follow them into all the mistakes. Let's use them as an inverse mentor and, control or reduce. So they're saying to reduce, for the people that are consuming animal products, they're suggesting they can reduce them by a third. That's the latest recommendation in China. And just scaling back by a third is estimated that it would remove a large chunk of the, as I say, the emissions in the planet itself, up to 1.5% of global emissions, greenhouse gas emissions.
Would you see your grocery bill go down as well?
Well, you know what? It depends, because we are a vegan-based family, and I have to buy a lot of fresh foods to feed, everyone and keep everyone feeling full and happy. So it is not a cheap pursuit. But again, if you look at the costs of eating, destructive or damaging diet is very cumulative and impacts so many things. I would argue there's a lot of cost in that as well. So it's, I guess it takes a while to get onto it, and if you're not growing any of your food, certainly buying all fresh, trying to buy organic, has a premium on it. But I recently found some wholesale places that you can purchase, and then the good news about that is if you can buy some wholesale, you also cut out all the plastic packaging that tends to come with buying retail. If you go to the local Loblaws or Zehrs or whatever your local grocery store is, and you're trying to buy fresh produce there, you tend to get a lot of plastic packaging, which is also something I'd like to avoid. So it takes a lot of, I think, thought and planning. What I find great irony in is that, I've always been a working mother myself. I know that there's very limited time. The truth is, though, people will say they don't have time to make healthy food, and I would suggest that we really need to consider that unless we're making time to make healthy food, we're really undermining everything else we're trying to do in our life, whether that be raise children, whether that be, keep ourselves healthy so that we get to live into retirement and enjoy the savings we've set aside. If we're destroying our health or curtailing our lifespan because we're not taking the time to make good food, it seems to me that lacks a certain wisdom.
And of course, if you're making happy food together as a family, more family time together.
Yes, and I always say if you can teach kids good habits in their youth, they will, reap the benefits of that for the rest of their life. If you teach them bad habits in their youth, it makes it more difficult for them. They may have to reverse those bad habits later, and or as taxpayers, Jim, I'm always thinking about this from many aspects, but from taxpayers' perspective, I don't want to have to fund insatiable, medications and treatments in our healthcare system if I can help proactive trends. So I just think it's foundational, in every way. It's foundational to health and it's foundational to finance, to not be wasteful and to be very productive in the energy and the way that we use it.
And don't forget, too, with summer coming on in parts of Canada, some places later and earlier than others, we're going to see farmers markets over the summer. People really should take advantage of that fresh produce that's very affordable.
Absolutely. And, I find that people often, if you've never made much food or if you've never cooked a certain way, for example, if you only know how to cook with meat and dairy and lots of that stuff, it can be quite an education, and you feel sort of daunted or overwhelmed or panicked. You feel like, I can't, how am I going to do this? And I find there's some excellent books available. There's that, for example, Oshi Glows, which is a new cookbook that came out. There's another one coming out this fall, but it really is very user-friendly, and they have lots of websites. One Green Planet has this fantastic website which emails you vegan recipes, and once you get onto a few tricks, you find that it's actually quite quick and easy to prepare the stuff. It's just more a function of thinking about it in advance and making sure you have some of the fresh stuff in the fridge when you get home at night.
And for people who feel daunted too, maybe just one night a week, just one day of trying to do that can make a difference.
You know, Jim, I always say that I hope that I'm much healthier and much more evolved 5, 10, 15, 20 years from now than I am today. And I see this all as incremental. If you ever feel like, you know, you're overwhelmed, perhaps you think, oh, I have to stop smoking, I have to drop 30 pounds, I have to change the way I eat, I have to learn to exercise, I have to care about it can get so overwhelming, you know, that people just basically give up and don't try. So I always say just start with one night a week where you try cooking in a different way, you know, start walking. You know, don't feel you have to run out and buy expensive equipment or expensive gym memberships or, you know, buy all prepared foods from the local, you know, delicatessen or anything. Just try to step by step move along, and I think you'd be amazed at how it builds over time.
Danielle, thank you very much for being on This Week in Money.
My pleasure, Jim. Thank you.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. Her website is jugglingdynamite.com. That wraps up our show for this week. We'd like to thank our guests Ross Clark, Bob Hoye, and Danielle Park, and thank you for listening. Comments or questions for the show can be emailed to info@howstreet.com. I'm Jim Goddard. We're back next week with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.